Good morning. This is the session 4 of the FR revision for those students who are giving their exam in September 2026. Now, in this particular session 4, I have decided to take up a specific accounting standard, or you can say an IFRS 18, because there is a lot of query that has come from the student side and asking for what is IFRS 18 all about. Changes have taken place in IAS 1 and IFRS 18 has replaced IAS 1. So what are the different types of questions that can be asked? Because since it's a new accounting standard, will there be any changes, major changes? So today I decided to take up about 20 questions or so, which I have compiled on the basis of different queries which are raised by the students. And I've decided to address them in my session 4 of audit of FR. And therefore, let us start with the first question as to what is the core objective of IFRS 18 and how does it differ from the objective of IAS 1 that it replaces? So if you go to see the two accounting standards, that is IFRS 18 and IAS 1, the basic difference between the two objectives as such. If I talk about IFRS 18, IFRS 18 ka objective is set out for the presentation and disclosure of information in the financial statements so that it provides a sound basis for the users of the financial statements to understand a company's financial performance, basically by improving the comparability and transparency in the statement of profit or loss. Earlier in IAS 1, there was a lot of flexibility because it offered broad principles and significant flexibility in structuring the financial statements. So the broad principles allowed flexibility in the presentation of your profit and loss. But IFRS 18 now mandates specific categories, defined subtotals, and structured disclosures to reduce diversity in reporting practice. Let us take up the second question as to why did the IASB choose to focus primarily on the statement of profit or loss rather than considering all the aspects of IAS 1? Why focus only on the statement of profit or loss? Why not all the aspects of IAS? Fine. Let us address that. The IASB, that is the International Accounting Standards Board, found that investors' biggest grievance or complaint was that there is inconsistency in the presentation of financial statements, especially profit and loss account, making it incomparable. So it was not possible, it was inconsistent, incomparable presentation of operating profit and inadequate transparency around non-US GAAP adjusted earning measures. So it prioritized fixing the income statement rather than undertaking a full rewrite of IAS 1. So the focus was basically on the statement of profit or loss, because there was no clarity when you are comparing two profit and loss account statements of two companies, because the presentation was slightly different from each other. So comparison was not possible. So this targeted approach allowed faster issuance while addressing the most material concern of the investor, because we are always trying to make things easier for the investor. Let us now look at the third question. IFRS 18 is effective for annual periods beginning on or after 1st January 2027. What transitional disclosures must entities provide in the year of first application? So let us see when we are transitioning is taking place from IAS 1 to IFRS 18. So what will be the measures or disclosure requirements which will be required? So IFRS 18 applies retrospectively, including to comparative information, meaning that entities must disclose the nature and the effect of the transition on previously reported figures, consistent with general IFRS transition requirements. Earlier application of the principle is also permitted. Right? What is the fourth question? The fourth question says, identify the standards to which certain IAS 1 paragraphs were relocated under IFRS 18 and explain the rationale for this restructuring. Fine. Let us try to do this also. The International Accounting Standards Board retained many of the International Accounting Standard 1 paragraphs, and they were largely unchanged within IFRS 18 also, but moved certain provisions to IAS 8, that is basis of preparation of financial statements, and some things were moved to IFRS 7, that is financial instrument disclosures, reflecting a reorganization of content rather than substantive changes in these specific areas. So there was a shift of certain provisions from IAS 1 to IFRS 8, IAS 8 and IFRS 7. Okay, so that is the transitioning that is happening. Question number 5. IFRS 18 requires all income and expense items to be classified into one of the 5 categories which have been given. So list those categories and give one example of an item that will fall into each category. Fine. So here are the 5 categories that we have to report. The first is operating, second is investing, third is financing, fourth is income tax, and fifth is discontinued operations. Once again, I repeat, the first is operating, the second is investing, the third is financing, the fourth is income tax, and the fifth is discontinued operations. Examples as the person is asking of each category. Revenue from core business. That is, what is your main activity, manufacturing activity. So what is your manufacturing activity concerned with? If it is a service that you are providing, then what is the service that you are providing? So the core business. Second, interest income on investments. The interest that you are receiving on the investments that you have made may be in the bonds of other companies. That will be an investing activity. Interest expense on borrowings, the loans that you have taken, the bonds that you have issued, on that you are paying the interest, it is an expense. So that is an example of financing activity. Tax expense, as simple, income tax that you are paying, and the results of a discontinued segment of the business. One unit of the business has been discontinued. So discontinued operations, the results of that. So that completes the first 5 set of questions. Let us come to the next 5 set of questions. Question number 6 says, explain why share of profit or loss from the associates and joint ventures is classified under investing rather than operating, contrary to common practice under IAS 1. Share of profit or loss from the associates from the joint ventures, why should it be classified under investing rather than operating as it was done in IAS 1? Fine. Let us discuss that. Under IFRS 18, results from associates and joint ventures are classified under the investing category because these entities are not part of an entity's core operating activities in a way that reflects operations of the reporting entity itself. Meaning that what is my, let us say that I'm talking about A Limited or A Incorporation. Now, what is the main manufacturing activity of that particular business? Maybe that company is involved in the manufacturing of garments, textile industry. So that is the core operating activity. Investment which has been made by this particular A Incorporation in associates and joint ventures may not be a part of the core manufacturing activity, that is manufacturing garments. Therefore, it should not be taken as a part of operating activities, but it should come as returns from investments which have been made in other joint ventures or associates. So that should come under the investment category. Just like any other investment that you are making in any other company, and the returns are coming either in the form of interest or in the form of. So suppose that this particular explanation is quite clear. Coming to question number 7. Under what circumstances would interest income on trade receivables be classified as operating rather than investing? Interest income on trade receivables from your customers, how it will be classified as operating rather than investing? Interest that you are collecting from customers is maybe because of delay in payments. Customers come into existence on account of operating activities rather than investing activities. So, when it arises from an entity's main business activity, for example, you are selling goods to your customer, and that customer has been sold goods on credit basis with the condition that any delay in payment will result in interest on overdue balance, then it is supposed to be a part of operating. If generating investment returns on receivables is integral to how the entity earns revenue, rather than being incidental investing activity, then it will be a part of investment. Okay. Coming to next question, question number 8. For an entity whose main business activity is investing in assets, example, an investment fund, how does IFRS 18 modify the standard categorization rules? So let us see that. For entities whose main business activity is investing in assets, main business activity, like you have manufacturing garments. So for investment companies like mutual fund, insurance companies also, its main business is investing in assets of other companies. Then IFRS 18 provides exceptions so that returns would normally sit in the investing category, like dividend income, interest income. And therefore, they are instead classified as operating, since this reflects the entity's core fraction. Okay. Next question, that is question number 9. IFRS 18 introduces 2 new mandatory subtotals. One is operating profit and the other is profit before financing and income tax. You are asked to define each and explain why both must be presented, even when numerically identical. Even though both are same, you have to show them separately. Fine. Operating profit is the total of operating income and expenses classified in the operating category. So that is operating income minus operating expenses. Profit before financing and income tax is operating profit plus investing category results like interest received, dividend received. Both are required. Both are required, even if numerically equal. That is, when you don't have any investing activities, there is no income from investing activity. But still, both you have to show for consistency across all the filers, all the companies. Filers are those companies which are going to present and file their financial statements, allowing the users to compare companies on a like-for-like structural basis. This item in this profit and loss account compared with the same item in the other profit and loss. So operating profit in A incorporation compared with operating profit in B incorporation. Profit before financing and income tax in A with profit before financing and income tax. Right? So that is your answer to question. Coming to question number 10. Compare the previously optional subtotals of gross profit and profit before tax under IAS 1 with the treatment under IFRS 18. Under IAS 1, subtotals like gross profit and profit before tax were optional and inconsistently defined across companies. IFRS 18 elevates operating profit and profit before financing and income taxes to mandatory status, precisely defined subtotals, though gross profit itself remains optional. I suppose the questions, the first 10 questions have been answered and understood by all of you. Right? Let us go to the next set of 5 questions. Question number 11. How does the introduction of the operating profit subtotal change the starting point for the indirect method statement of cash flows? It's a very interesting question that was once asked to me by a student in the class. There was an online session and I was asked this question, okay, sir, why start with operating profit for cash flows, statement of cash flows? Earlier we used to start with net profit before tax. So abhi aisa kyun? IFRS 18 mandates that the operating profit subtotal, rather than any other starting point a company previously chose, must be the starting point for the indirect method reconciliation of operating cash flows, which will make it standardized practice for all corporations. So again, we want a consistency, we want comparability of one cash flow statement with another cash flow statement. Okay, so that is the reason why in cash flow statement we are starting with operating profit, because in some cases the company used to start with profit before tax. Some cases the company used to start with profit after tax and then add back the tax and arrive at profit before tax. So a lot of things were there which were done by the companies, so it was different from company to company, thereby making easy comparison of two cash flow statements a little bit difficult. Okay, so that addresses your question number 11. Question number 12, from here onwards, we have management defined performance, so what we call as MPMs. So question number 12 takes up a issue. Define a management defined performance measure, MPM, under IFRS 18 and explain how it differs from a non-GAAP measure disclosed outside the financial statements. An NPM is a subtotal of income and expenses which are not specified by IFRS. Accounting standards that management uses in the public communications to convey its view of an aspect of financial performance. Unlike in the case of informal non-GAAP measures disclosed outside the financial statements. For example, in the earnings release, the management defined performance measures must now be disclosed within the financial statements themselves and subjected to audit. Okay, so I suppose that explains the question 12. Let us come to question number 13. What specific disclosures does IFRS 18 require for MPMs, and why does the IASB consider this a step towards greater transparency? Fine. Specific disclosures required for MPMs. Entities must disclose the rationale for the NPM, the reason, the logic, how it's calculated, and the reconciliation in the most comparable IFRS defined sum total, including related income tax effects and non-controlling interest impacts. This is a deliberate transparency measure since inconsistent non-GAAP reporting has been a long-standing complaint of every investor. Right? So, again, the basic, if you go to see all the questions, the answers that I'm giving comes to one particular point, that is consistency, comparability. Fine. Let us come to question number 14. Discuss the potential audit and assurance challenges introduced by MPM disclosures, particularly regarding reconciliation to IFRS defined subtotals. Because MPMs now sit inside audited financial statements, they are within the audited financial statements. It becomes necessary for auditors to verify and reconcile and also verify the reconciliation methodology and the judgmental classification, raising complexity around evidencing management's rationale and ensuring consistency from one period to another period. Okay, so that is the reason. Fine. So anything that you find difficult, or you can just rewind and see what are the answers that have been given. I've tried to address as many issues as possible, but still there may be certain issues or certain questions that remain unexplained or that still remain as doubt in your mind. So we can come back and address those issues also. Right? Okay, coming to question number 15. Explain the new principles IFRS 18 introduces for aggregation and disaggregation of items in financial statements and how they aim to reduce the line item overload. And IFRS 18 introduces guidance requiring items to be aggregated or disaggregated based on shared or dissimilar characteristics, aiming to prevent both excessive line item clutter as well as inappropriate netting of dissimilar items, thereby improving the usefulness of the income statement. Okay, so I suppose all these 15 questions have been addressed properly to the understanding of everyone. Let us now go to the last set of 5 questions that we have and address those 5 questions also. Question number 16 that we have is asking, using a hypothetical multinational manufacturer, draft a comparative statement of profit or loss under IAS 1 versus IFRS 18, highlighting reclassification of at least 3 line items. Now, I will not be actually preparing a profit and loss account or a comparative statement, but I'll tell you what are the things that are required to be addressed here. A manufacturer, for example, would reclassify equity accounting or equity accounted associate income from operating to investing, interest expense from general finance cost to the defined finance category with stricter presentation alternatives which are removed, and a previously ad hoc adjusted EBITDA, that is earnings before interest, tax, depreciation and amortization figures, would now require formal MPM reconciliation disclosures. Okay, so these are the things that will be different comparison के लिए. So these are the things that can be highlighted as a reclassification items. They are asking for 3 line items. Okay, fine. Right? Let us come to next question, 17th one. Analyze how IFRS 18 might affect the comparability of financial ratios. For example, operating margin, EBIT across companies during the transition period. So when you are switching over from IAS 1 to IFRS 18, because operating profit is now precisely defined, this an operating profit is clearly one subtotal that we require. So it is properly defined. Historical operating margins may shift as items move between categories. What is originally operating may have now gone to investing and vice versa. Associate income, which leaves operating profit and goes to investment category. Meaning that the analysts must be more cautious comparing pre and post 2027 ratios, because we are interpreting those ratios. So maybe that there is going to be a change in the interpretation of those ratios prior to 2027. And they should expect a transitional period of reduced like-for-like comparability. Okay. The last 3 questions, or the last few questions, I would say, address on the research and critical analysis. So let us see question number 18. To what extent does IFRS 18 address long-standing investor criticisms about inconsistent presentation of underlying or adjusted earnings measures across companies. IFRS 18 is directly targeting the long-standing concern of the investor that non-GAAP adjusted or underlying earnings measures are varied widely in definition and quality across companies. By mandating disclosure and reconciliation of NPMs within audited financial statements. But this does not eliminate alternative measures, which forces greater rigor and comparability around their use. Coming to the second last question that we have. Evaluate whether the mandatory 5-category structure under IFRS 18 could reduce management's ability to present earnings in a favorable light compared to the flexibility under IAS 1. We started with this particular question, right? The 5 mandated categories that we have discussed today and defined the subtotals meaningfully constrain the management's ability to present earnings favorably, consistently, with comparability as compared to IAS 1, where IAS 1 was flexible, though judgment remains in classifying items, whether certain income should be operating income for a specific business, which could still create some inconsistencies between companies. So, for example, a business which has got its main operational activities as investing in the shares or bonds of other companies. So the income that they are going to get, whether that is operating income or investment. Finally, the last question that we come to. What are the anticipated implementation cost and system changes for companies transitioning to IFRS 18 by the 2027 effective date based on Big Four advisory analysis? Big Four analysis indicates implementation will require remapping charts of accounts because there are some changes in the classification, redesigning the financial statement templates, updating your ERP system and close the processes, training of finance and audit teams, with smaller entities expected to face proportionally greater challenges, adapting to the requirement, the reporting systems by the 2027 deadline. These are the anticipated implementation cost and system changes which are expected for transitioning from IAS 1 to IFRS 18. So friends, I think this has addressed most of the questions on IFRS 18 and the transitioning of accounting standard IAS 1 to IFRS 18. More discussions to follow, more revision lectures to come on FR. We will be taking up certain questions based on the requirements of the students from the exam point of view. So keep in touch, and I will be back once again with some more interesting, some more explanatory questions on this particular subject, financial reporting, which is very close to my heart. Thank you. Have a nice day. Bye.